Welcome to Crescat's live market call featuring our macro and activist mining research. I'm Kevin Smith, Crescat's founder and chief investment officer. Before we get started, please refer to our important disclosures pages on the screen now. These can also be found in the description on Crescat's YouTube channel and on our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both the positive and the negative news across our holdings as they arise. These videos represent the opinions of Crescat as a mining and exploration industry advocate. Our objective is to share the overall geologic progress on our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The securities discussed herein do not represent an entire portfolio and in the aggregate may only represent a small percentage of any Crescat Strategies holdings. The issuers discussed may or may not be held in Crescat's client portfolios at any given time. This video is not intended to be, nor should it be construed as an offer to sell or a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you are subscribed to our YouTube channel to get notified of upcoming episodes. You can also follow Crescat Capital on Twitter for ongoing macro research and important news updates on our activist metals positions. If you enjoy or if you want to learn more about Crescat's investment strategies, we strongly encourage you to reach out to Merrick. His contact information is on the screen now and can also be found on our website at crescat.net. So as usual, our format is, I'm going to discuss a little bit about our investment strategies and a little bit of macro. Tavi will go more in depth into macro, and then Quentin will talk more about our activist metals strategy and some of our positions there. So without any further ado, let's get going. So this week we got the BLS, the Bureau of Labor Statistics. Based upon the census data that came out from the U.S. Census, they did their preliminary revisions, which they do every year at this time through March, to the payroll data. And what it showed is that the payroll data, their data, the BLS's data, had been overstated by over 800,000 jobs. And this, of course, was the biggest downward revision at this time of year to the jobs data, going back to, you guessed it, 2008 and early, actually the middle of 2009. What was 2009? Of course, we were in the midst of a recession at that time. So we're seeing the same kind of recessionary downward revision to payroll signal as we had back in 2009. And this is yet another recessionary signal from the macro data that we're getting. I think a lot of people perhaps don't realize that back in it wasn't until December of 2008 that the NIBR, the National Association of Business Economists, they're the body that officially calls a recession. They didn't call the recession until December of 2008, and they said that it began in December of 2007. Okay, and this is typically what happens, is that we will not know there has been a recession officially until we've already been in it for a while. And this is the type of data that is signaling that a recession may have already started. So let's go on to the next. So that this month has been quite a month in the financial markets. We had the unwinding of the yen carry trade. We had a spike in the VIX early in the month. It happened literally on a Friday and a Monday morning. And since that time, the markets have been screaming higher. And what this chart with data from FactSet is showing is that you've had three things going higher all month that are kind of at odds with each other. Bonds have been going higher, gold has been going higher, and the S&P 500 has been going higher. At the same time, the dollar's been coming down, crude oil's been coming down, copper's actually been coming up. But those main three things on the top are these things don't really go together, right? At least one of them is lying, if you might say. In other words, bonds are rallying because the Fed is easing and we might be going into recession, so bonds are rallying. Gold is rallying because the Fed is going to be easing, and it might be an inflationary hard landing type of a recession. But the S&P is going up too on that because people think that rate cuts are bullish for the S&P. Well, you can't have all these things at the same time. Anyway, let's just pose that at least one of them is likely to be wrong. Let's go on to the next. Of course, one for sure that we think is likely to be wrong here is the S&P 500. We believe, as we've shown many times in our letters and in our prior videos, that we're at historically high valuations for stocks, for the S&P 500, for growth stocks, especially in large cap growth, tech especially. This is just showing positioning data. So positioning is a contrary indicator, because if everyone's on one side of the boat, which way are they going to have to move? Especially if we do end up going into a recession, whether it's a stagflationary one or more of a, even if it were a deflationary hard landing type, and everyone's long, which way are they going to have to move? So this is showing positioning in the futures markets. This data from J.P. Morgan and Bloomberg showing CFTC futures positioning of asset managers and leverage funds being record long stocks. And we're looking at the S&P 500, the Dow Jones, and the NASDAQ futures markets. If positioning of asset managers is record long, can it get longer than that? Not typically. And then at the same time, we're looking at short interest in the SPYs and the Qs, the S&P 500 ETF and the NASDAQ 100 ETF. Short interest as a percent of shares outstanding is historically low. Going back 6 or 7 years, this is the lowest it has been. People are afraid to short. As most of you who follow us know, I'm not afraid to short. Of course, we've had a bearish view for a while. It hasn't played out yet. The risk of having short positions is that that it can hurt your performance when it's going against you. But it can also really deliver high alpha and positive returns when it's working in your favor, when you have the right kind of setup. That's why when you look at our global macro fund, for instance, you can see that it has since inception. You can look on our website and look at our performance reports, and you can see that it has a negative downside capture ratio. What does that mean? It means you look at all months going back to 2006 of our global macro fund, and on average, when that S&P 500 has gone down, our fund has actually gone up. You can go look up that data and the disclosures on our website if you're interested, because we're not afraid to have short positions in the portfolio and to dial them up when it makes sense to dial them up based upon our research. Let's go on to the next. This is looking at technical charts. These are daily candle charts, courtesy of i3 Invest, and this is is just showing these bearish engulfing patterns that we just had yesterday. These are daily candles on the S&P 500 and some of the Mag 7 mega cap tech stocks. Bearish engulfing. It's a technical signal. It could be a bearish signal. There's it's just something. Look, that there's risk, there's reward. We're not saying that it's a guarantee that stocks are going to, come down because of this technical signal alone. But it's one of a composite of many signals and factors, macro and fundamental, that we look at to form a view. And we're bearish right now on these types of stocks and on the S&P 500 at large. Let's go on to the next. This is showing a B of A quant model, the EPS growth model that they believe that looking forward 12 months, that earnings growth indeed is going to be slowing down to a 5% rate of growth. This is the MSCI, which is a global equity index, heavily comprised of U.S. stocks, by the way. They're projecting that earnings will be growing only at 5% year over year for the entire global equity market. This is a significant, pullback in growth expectations, yet another bearish signal for the markets. Let's go on to the next. So we had this big one-day spike in the volatility index, aka the VIX, which is it's a CBOE options volatility index on the S&P 500, and we had this one-day spike, and it got everyone pretty scared, and we've since rallied back to near all-time highs once again. But that huge volatility spike on a one day, when you smooth it over a 10-week moving average, it looks like we haven't seen anything yet. This is consistent with our view and with why we're still using put options to express a lot of our short positions, because volatility is cheap. Put options, give you that asymmetric. We believe it gives you that asymmetric upside return without the high risk, and therefore we express our shorts with puts. Let's go on to the next. Here's some data looking at the issuance of U.S. Treasury notes and bills, and this is a measure of liquidity when the U.S. Treasury is issuing notes and bills. People lately have been calling it fiscal dominance, or this idea that the Treasury is creating the liquidity in the market, doing the work that the Fed hasn't been doing well while the Fed has been in interest rate hiking mode and tightening mode, and that's why that's why the markets have been strong, is that the Treasury's been doing the work, and but this is looking at the total issuance of notes and bill with a pushed 9 months forward. Okay, so the notes and bill issuances have actually been contracting, and when you push it 9 months forward, are signaling a downturn in liquidity. This is compared to the MSCI Global Equity Index. Once again, it's heavily U.S. based, and it's showing that this works with it's cyclical, and it works with a 9 month lag, a 9 month lead, that is, and it's signaling a contraction in equities. Let's go on to the next. So the inflation data, Jay Powell spoke at Jackson Hole today, and it was like he was giving a victory lap speech that was reminiscent, somewhat reminiscent of the days when very confidently they stated that inflation was going to be transitory, back in late 2020, early 2021. And he made a joke about the transitory, that team transitory, and as if it was funny that they were wrong about that. But it was almost like they're doing a victory lap again. It's almost like they're doing the same thing again, claiming that they have, that they've, very confidently that they've got inflation under control, so that now they can begin to ease. And we'll see. We don't share the same view. This is looking at the difference between discretionary and non-discretionary inflation. So discretionary versus non-discretionary spending. What is that? Well, non-discretionary is the stuff that you have to buy every month, whether it's food or paying your rent or the necessities of life. And non-discretionary inflation is still running at 4%. This is the stuff that's hitting the broader swath of the population the most. Yes, discretionary inflation has come down. Of course, we expect inflation to be accelerating again, especially as the Fed now goes into easing mode. We believe there's still a lot of supply-demand imbalances, especially for hard assets, for commodities, and especially for metals commodities, given the huge push to EV, to electrification and electric vehicles and data centers and AI. We think there's a huge supply deficit in metals that's shown through lack of exploration and drilling and building new mines for the last dozen years plus. It's about the last 14 years, this trend. And we think there's much higher price spikes to come in the metals markets. Let's go on to the next. So this is from B of A, and it's looking at what happens. So everyone knows now, right, that the Fed is going to be cutting interest rates. They've signaled it. Jay Powell just confirmed it today in Jackson Hole. And so where do you invest when the Fed is going to be cutting interest rates? This shows looking at different sectors in the economy, both defensive sectors and cyclical sectors on the left-hand side, the sectors that are the biggest beneficiaries of falling interest rates. And real estate, of course, is one of the highest, along with utilities on the defensive side of things. On the cyclical side of things, it's materials and industrials. So if you believe that this is more of a soft landing type of an environment, that there will be a rotation into cyclical sectors that benefit from the rate cuts, and that the overall economy will continue to chug along as new sectors take leadership in the cyclical space. And markets are discounting mechanisms, so they look forward. If you think this is going to be an environment kind of like the tech bust in 2001, where new industry groups can take leadership even as the old industry groups are coming under severe pressure, materials and industrials, those are the ones to look for. So what's the chart on the right side of this page here? Well, it's saying that now it's looking at what's the most overowned things today and what's the most underowned. So if you look at the combination between what's the most underowned and what's the most likely to benefit in a cyclical push higher for the economy under declining interest rates, it's the materials sector that is at the top of the list on both of those measures. The most underowned asset class, the most undercapitalized asset class, and at the same time, it's the one that clearly is a beneficiary of declining interest rates. If you're interested, this is how we are positioned at Crescat. We are long materials. We're along the materials sector. We're primarily doing that through the metals and mining industry, which we think has the best fundamentals among all the materials industry groups today. Let's you can see energy is also in there. Commodity industries, hard assets are favored here. Let's go on to the next. This is probably my last chart. Tavi likes to show this chart. It's from Incrementum AG. They've updated it recently. I think we helped them with that everything except commodities notation that they put on there, because that's something that we put on one of our charts at one time. But this is looking at the S&P to the Goldman Sachs Commodities Index. We're we're of the contention that we're going to be going into a rotation out of overvalued large cap growth stocks into undervalued commodities and commodity equities. As you can see from this chart, it hasn't really worked in a big way, in the past couple of years. In fact, it's gotten even worse since we first started highlighting this chart, and so we've been fighting. We've been looking forward, trying to get ahead of these trends, and we've done that. We've done that in a huge way with the positioning that we've built, especially in our activist long metal strategy. We believe it's deeply undervalued and has a lot of upside appreciation potential. Is there risk? This is showing the risk. It's showing the risk that, in this case, that we've been too early, and when you're too early, you can suffer. But we haven't suffered all that bad. We're most definitely still in the game. This month is a glimpse. So I showed you that first chart where gold was going up. Well, guess what? Gold mining stocks have been going up even more than the price of gold. So after that little hiccup that we had at the beginning of the month for the S&P 500, as everything has come roaring back this month, there is new leadership in equities coming. And where is it coming from? It's coming from certainly one of those industries is the mining industry, and mining stocks not only outperformed the S&P 500, and our mining stocks did as well this month, but they also outperformed the price of gold itself. I mean, a lot of people have been saying gold's going up, but mining stocks are still lagging, and that's the opportunity. So we like to say the lag is your friend. There is a huge valuation discrepancy. Gold's already shown the way. It's already broken out. There's a lot of catch up to do in the mining stocks. We believe they're extraordinarily cheap. Is there a risk? Of course, there's risk too. But look at the opportunity. This chart shows it really well. That's it for me. Went longer than usual, so I'm going to turn it over to Tommy.
All right, thanks, Kevin. Well, there's a lot of things kind of coming together. It's almost like putting a puzzle, a macro puzzle, and it's never simple. It's never an easy task, but it feels like a lot of things are coming together. And it's not just the gold price is moving higher. There's other things that are starting to move along in the same manner that I think will sort of be very meaningful in the following decade or so, because it's likely to be the case that we have lots of trends to be invested in this next 10 years, in my view. Now, we had Jay Powell actually speak today, and lots of takes on that. And several people or multiple analysts have shared their views, and certainly that seems to be that it's open for a 50 basis point interest rate cut, given his views about inflation and his concerns about the economy and all sorts of things. But at the end of the day, what really matters is the chart that is right in front of you. I've illustrated this idea in many different ways. One of them is looking at the interest payment relative to GDP in the US, and which shows one of the largest percentages in the last 2 centuries and a half. And this chart is just giving some perspective on if we were to cut interest rates in the following year or so, which is July 2025. If we do as you can see, a projection of assuming rates to be stable, that would actually be the case, that an increase of about 27% in interest payments by about 1 year. Those are, we're talking about a really significant shift in the service and the cost to service the debt, in which is starting to become a burden, not only for the government, but really for the Fed. And so ultimately, despite our views about inflation and labor markets, this is likely to be the thing that will really move policy making moving forward. And I think they're acting accordingly, in my view. And you know what I think would be shocking for a lot of people, but very likely to be another outcome in markets as we see here that the following, call it 2 to 3 months, is in what happens if we do see inflation reaccelerating and the Fed really communicating that we'll be cutting interest rates and actually starts to acting that way and starts to actually cutting rates. What would they do? And I actually think that they'll probably be forced to ignore. That to me would be showing their cards. And in the name of the game, in my view, is owning hard assets. And that's what ultimately drives everything higher, in my opinion. So let's go to the next chart. So in this next chart, we're looking at, as a chart I showed before, and I'm using this chart again today just because it's relevant. It's because the Fed is making essentially a shift in policy that over the last months and has been signaling some of that. I think today was a big confirmation. But ultimately, if there is 1/3 of the debt is actually going to be maturing in the next year or so, that means that if the T-bills market and basically the Fed interest rate policy is very significant as well in terms of how they can possibly manipulate or really stipulate what the cost of the debt would look like. And so, cutting interest rates will have a direct impact on the government being able to alleviate that burden from the debt side. And so, looking at this chart and seeing how large it is, the amount of maturing debt over the next year relative to the overall debt. And as we see this actually peaking in prior recessionary periods, this to me is actually a concern. And remember, the reason why we see these spikes is because we tend to see a lot of T-bills being issued when we have a recession. And that is because the market tends to absorb those instruments much easier during periods of panic. And that is the case today. We're seeing all sorts of programs in terms of the issuance of T-bills relative to other bonds or other tenors in the treasury market. And that will certainly have an impact in markets overall. So to me, this is why the Fed has been communicating so strongly. I think some people were a little bit shocked. But what is yet to happen, in my opinion, is not just the rate cuts, is what if we see rate cuts with inflation reaccelerating? I'm going to make that case here in this presentation. Let's go to the next chart. So in this one, we're looking at the DXY index. I think this is probably the most important chart of this whole presentation, is looking at what's happening with the dollar. I mean, the dollar is absolutely collapsing. I mean, collapsing, I think it's the right word. I mean, if you see the many crosses, not just the dollar versus the euro, but the British pound and all sorts. And I'm going to show here in a minute. But clearly, we have broken a very important support for the DXY index. For those who don't know, the DXY index is heavily weighted in the euro, the British pound, the Japanese yen, and some others. But that's really the thick of it would be those ones. And I want to remind you, I mean, this whole thesis that we had about how the inconsistency of the interest rate policy in the U.S. versus the size of the debt versus other economies out there. Even in Japan actually paying only 0.5% of GDP in interest payments. Relative to the U.S., that is multiples of that. We're at four approaching close to 5% in a year from now. Those things are going to have an impact in FX. And this, if you notice this chart, look at 2021 all the way to 2022. As a large appreciation in DXY. That was the inflationary period. And so notice how inflation developed during that time in a very different way that is likely to develop today. And the other thing to notice here is that, one thing is to have a collapsing currency without no issues in your fiscal problem or even your current account issue. Now, if you're running a current account deficit and a fiscal deficit, which we call this a twin deficit. And the U.S. is forced to do that because it is the reserve currency. Now we're approaching double digits of that twin deficit. And now you have a collapsing value of its currency relative to other fiat currencies. And you rely so much on imports. This is clearly very, very inflationary. So to me, this is something that is yet to become a conversation in terms of what the Fed and other policymakers. If you go to the next chart, what is the most important chart happening right now across all these currencies? Well, first, look at the euro. The euro on a quarterly basis. Why am I using quarterly? Quarterly is actually a good chart in terms of stepping back. And you can see this is going back to all the way to the global financial crisis. And notice, if you get into a bullish environment for gold itself, usually unleashes other things. You tend to see other fiat currencies performing better than the dollar. You tend to see emerging markets doing better than developed economies. And so all these commodities overall tend to do much better. So would it surprise you if we break out from this very significant or historical, I should say, resistance line? And if we go to the next chart, it maybe gives us some idea of what likely to happen. Can we go to the next chart? I think it shows the British pound now, and it already did that. Already broke out of that resistance, and now we're probably going to, in my view, accelerate to the upside, and other currencies are yet to follow. Take a look at the Canadian dollar, for instance, and the Canadian dollar is very close to doing the same thing as the euro. So all these currencies are reaching a very critical level right now, technically speaking. And in my view, a lot of people are not really seeing this as a big deal, and that's kind of usual. We tend to, history, given the fact that we hit this resistance so many times, that people sort of lose faith that there is a potential that these currencies can actually really appreciate relative to the US dollar. It's been one of the most, popular views that the dollar is the cleanest of all the dirty shirts out there. But I have shifted my view on this. I definitely think that this is not the time to have that opinion anymore, and especially because of that, the divergence of monetary policy in the U.S. versus other places. The U.S. has a much larger sense of urgency to act than other places. Let's go to the next chart. And so the impact of this is, in my view, highly inflationary. And you can see some of these signs. Like I said, the macro is all this sort of puzzle you're putting all together. So I showed how currencies are trading. Now I'm going to show how the CPI, basically the expectation for CPIs by the market is being shown. And this is a tenor of 10 years on the break-even rate. And you can see that we're now hitting a resistance right now as well on this one. It shouldn't shock anybody if we see the euro breaking out, which is highly inflationary, the British pound continuing to move on the same trajectory. If we see the Canadian dollar and other currencies also moving the same way. And then on top of it, we have this chart potentially actually bottoming. So let's look at other tenors. If we go to the next chart, and you can see here the 30-year. The 30 years is slightly different. It broke out, and you can see that sort of very meaningful breakout historically as well. And I think it was meaningful in a way of entering an inflationary era from a macro perspective. And we've been sort of in this, very long consolidating period. And one of the reasons why we've been consolidating is energy. Energy has been consolidating almost exactly the same way. And so, in my view, it's kind of hard to believe that this line is going to bottom. Let's just assume that the probability of this actually bottoming along with the 10-year break even and others, and energy will not participate on this. And so this is why I think that energy is actually becoming more and more a critical asset to own in this environment of today. That doesn't change any of my views in metals, of course. I think it only solidifies that view of the metal space, in fact. But on top of it, I do think that energy will also participate on this. So let's dive in a little further. Let's go to the next chart. This is the 5-year. The 5-year is even more obvious that it's probably close to a resistance, I should say a support. Remember, it used to be a resistance all the way 2004. We hit that yellow line many times in history. We hit that in 2004. We hit that in 2007. We did it again in 2012 or so, or close to it, 2018. And then finally in 2020, coming out of the COVID recession and all the expansion of the monetary base and money supply that we saw and inflation getting out of control, we finally broke out of that line. And guess what? We're now retesting almost perfectly that same resistance that is now, in my view, likely to become a support. So, to me, this is another example. And by the way, we should give more relevance to the 10-year because, full disclosure there, the 10-year break even has a better liquidity profile and therefore tends to have a more, a stronger signal to where inflation is probably likely to be heading. And in my view, it would be very plausible to see all these currencies actually outperforming the dollar, becoming very inflationary. And it is interesting how inflation tends to develop. The beginning of this was just supply related for a lot of people. In my view, was fiscal and monetary related as well. But now it's actually translating into other things. The FX movement with a twin deficit, actually is highly inflationary, and a lot of people are not seeing that way. And I would like to remind you, after conversations with other folks that brought this up, that even the core CPI or core PCE actually have base effects built into them that will likely actually drive those numbers much higher. So, in my view, the Fed is going to be in a very difficult position here, where if inflation does actually start to bottom and in the process of bottoming here in a big way, then what would the Fed do? And I think we'll see their cards of how the political constraints of actually not being able to afford a restrictive policy. That's the main part, not being able to afford a restrictive policy, given the size of the interest payment relative to GDP imbalance. That is going to start actually being, in my view, a supercharged environment for commodities. And so that's why I'm paying close attention to all these charts. But let's go to the next one. Now, the next one, we're looking at another, potential indicator that could be leading to the upside and forming a bottom is actually the wage growth. And you can see here in different ways. We're looking at this is the Indeed website, which I think it's a great way to, it's, very used by a lot of people looking for jobs and all sorts of things. And so it's a good way to track, I guess with a more, accurate and also more, current number of what's happening in terms of that. And you can see that we're starting to form a bottom there as well in terms of the wage growth. Now, if you dive in a little further, if you go to the next chart, you can see that we're starting to see actually the high wages segment, which is the darker yellow. So now I'm breaking that down into low wage, middle wage, and then high wage. And you can see that the high wage is starting to bottom. In early 2020, as you can see there, the dark yellow line was also the first one that started to move too. So, it's something to be aware of. Wage growth is one thing that, at least I believe it's consensus at Crescat, or views that is also an inflationary pillar that will continue to to impact markets moving forward. So this one is an important one because it does affect how affect policy making. But again, I just want to reemphasize it won't matter because of the fact that we cannot afford any restrictive policy any longer. Let's go to the next chart. So then, another one that I've been showing here for some time now, and I find this, almost similar to the yield curve. And I want to be careful here talking about natural gas because I'm showing that 1 year forward curve in this space. And you can see essentially that, the contango, when you have a very severe contango in the curve of natural gas, it actually tends to mark important bottoms historically, at least. And the reason why I say that this is very similar to the yield curve is because if you look at other periods in history, what we're seeing today, it is different. I mean, we're seeing a much longer period of a contango staying at historically high levels. And that bottom period as well is taking a little longer than usual. But now, do I think that that won't work again today? Well, it's certainly not my view. I think this is all playing into that puzzle of inflation reaccelerating. And I think this is an important piece that could potentially add to that idea in a significant manner as well. Let's go to the next chart. In the next chart now, I'm showing a little bit more about the economy, what's happening with especially the yield curve, which in my view is, as I like to point out, it's one of the most important indicators anybody should be paying attention to. And the 2 versus 10-year yield is so close from an inversion. In other words, from this spread actually turning positive. And as we all have seen, and as you can see in this chart, clearly when we go from deeply inverted or just inverted back to uninverted level, it tends to happen during a recessionary period, during a contraction of the economy. So this is actually playing out. And the reason why I use the 2 versus 10 is just because it has a little longer history than the 2 versus 30s. But the 2 versus 30s have already actually turned positive. I was just measuring how many of the spreads are actually negative still, and it's still substantial. We're still talking about 80% of all possible spreads in the Treasury curve are still negative, and they're yet to, in my view, to turn positive. In other words, we may see a steepening of the yield curve, more broadly speaking, across most of the Treasury yield spreads. And I think one of them is also going to be the one you're looking at on the screen. But all of them, in my view, are probably poised to start moving to a positive direction. In other words, as we see the economy actually deteriorating, this indicator will actually coincide with that, and therefore likely to be moving much higher too. Let's go to the next chart. Lastly, here, you're looking at the gold miners versus the 2-year yield. I mean, the 2-year yield, for those that are not paying attention, the whole T-bills and chill idea, I know 2-year yield is not a T-bill. However, it's close enough, and you can see that the 2-year yield continues to move lower. And if you put that into perspective, what the gold miners tend to do when the 2-year yields start to move that way, it's interesting. Look at that period in 2018 or so when the 2-year yield started to move lower, and the gold miners actually had a really significant move. Now, I do think that will be the case today, where this decline of the 2-year yield, and I do think that it is possible to see much lower levels in the 2-year yield. It wouldn't surprise me if we cut in half where we are today, close to 4%. Cutting in half would be 2%. If you go back in a log chart of the 2-year yield all the way to the 70s or so, what you're going to find is that we would be just going back to that resistance line that we broke out, and now it would form a support. And so to me, that's plausible. And would that also shock me if we see the gold miners appreciate accordingly? No, it wouldn't shock me at all. In fact, historically, that type of macro scenario tends to be very beneficial for the gold miners. And so we're starting to see the gold miners perform better than gold itself. We're starting to see the juniors performing better than the gold senior miners as well. We're starting to see silver performing really well too. And so all these things are in my view, steps in the right direction of this industry. Let's go to the next chart. The next chart now is something that actually shocked me that I was looking at not too long ago, where the gold junior miners are actually outperforming NASDAQ 100. If that shocked me, I think it shocked a lot of people, because I tend to look at these things very often. And I wasn't too shocked that junior miners were, rallying, and not only that, but really outperforming NASDAQ this year. But over the last year, I mean, this is actually, NASDAQ has had one of the best rallies we've seen in the history of the index over the last year, and to know that actually junior miners have outperformed NASDAQ, and I would say virtually nobody knew about this. Not that I broke that news to the whole world, but honestly, I wasn't aware of this either. And I think that shocked a lot of people to see this indicator, or I should say this chart of the junior gold miners is starting to outperform the equity markets. And I think this is, again, if you recall, the gold to NASDAQ 100 ratio back in the early 2000s went up 13-fold during the tech bust all the way to 2011. And so I think that would be unthinkable today, and it wouldn't shock me at all again. And so, I pay attention to that relative performance of the miners versus NASDAQ, because I think too much attention has been given to the Mag 7 and all others, and not too much relevance for this movement in the gold miners and this improvement that we're seeing in this overall industry, particularly from fundamentals that I think are yet to actually show even more improvements over time. Let's go to the next chart.
Tommy, just real quick, can you elaborate a little bit on the junior miner index, compared to the types of companies that we consider junior miners and that are in our portfolio?
Yeah, and so junior miners that are part of the GDXJ, although there are smaller companies that are part of the GDX itself, they're not really junior miners that we see. I mean, they're slightly smaller market cap than the GDX itself, But the companies that we actually carry in the portfolio of Crescat are drastically smaller names in terms of market cap relative to them. They are the true junior miners that we see. In fact, it is a positive thing when one of the holdings we have in our portfolio actually become part of the GDXJ. It tends to be because liquidity comes back in. And by the way, I don't think this is I don't want to bash on the ETF itself, and the main reason for that is because I don't blame them. There's just a lack of liquidity overall in the industry, and it's hard for them to actually build a vehicle that can actually work or function normally in this environment. And so that is a function of the lack of liquidity in the industry as well. And I would suspect that as we see this cycle of gold and precious metals developing that we think will happen. If that actually happens, I would suspect that this is going to become more and more the true reflection of the actual junior miners. But the difference between, to answer your question, between this ETF and what we have is very significant. I mean, we're talking much lower market cap names, which, if we recall, those are the ones that actually tend to have bigger moves during prior cycles.
More exploration focus to a lot of the companies in this junior GDXJ ETF are mid-tier producers, I would say, a big part of the relative market cap of this index. And so you don't really get a lot of exposure to exploration where we're much more focused, because we believe there's even better risk reward, not without risk for sure, but better ultimate risk reward, especially going into the cycle that we believe we're going into. And our junior mine stocks have been performing this month in certainly better than gold itself, as good if not better than the GDXJ. So they did. There will be. We strongly believe there will be a cycle for junior mining companies and explorers, and it's coming. It's been a long time coming.
Well, the M&A cycle is really driven by the larger companies. As they see the share prices increasing, they would start also having more interest in using their currency, their share price, into acquiring. And I'm not saying anything new for the folks that are presenting here, but maybe for some of the audience. But that's their currency when it comes to acquiring other assets. And as we know, most of the industry is facing, not most, the entire industry is facing a supply cliff issue where there's lack of reserves and a really lack of exploration budgets, and also that reflecting as well in the lack of new discoveries that we see in the space. And therefore that is as we see the share prices of these companies, like you're looking at GDXJ, GDX, it should also be an important driver for the M&A cycle that we believe so strongly that is part of the whole thesis of owning exploration stocks too, is this potential for a large M&A cycle. And if I would point out to at least my views on that, I do think that this M&A cycle will likely be dwarf anything that we've seen in history, just given the constraints that most of those miners are facing. But nonetheless, that's just my opinion. Let's go to the next chart. And you can see more technically, again, going back to the GDXJ, technically speaking, just looking at the monthly candles. Again, this chart is good because if you're a technical analyst, you would really appreciate how many times we actually touched that white line and finally broke out. And the thing that really brings to my mind when I look at a chart like this is the amount of people that will likely be forced to change their opinions about the junior mining space if this is a true breakout. Now, if this starts to accelerate to the upside, imagine if you're a financial advisor looking at this, telling your clients that you should never invest in junior miners, and now 6 months from now, you actually have to tell them, well, hold on a second, I was actually wrong about that. And maybe we should own a little bit of junior miners. And so that's what drives the prices higher of any asset. I'm not talking about just junior miners, but given the fact there's an overly pessimistic view about this industry, the potential for new flows of capital from changes in views is also going to be, in my view, a big driver. Let's go to the next chart. I'm almost done. And then, similar to the chart before is the chart of Brazil. If you look at the Brazilian equities, which, by the way, those that invested in Brazilian equities in the early 2000s and carried that on all the way to 2011 in the most boring way, just using a Ibovespa index, your share prices went up 18-fold. That's crazy. I think that would be also unthinkable given what's happening. And so to me, emerging markets are very attractive. The ones that actually carry more exposure to natural resources like Brazil certainly look more attractive. And notice that I use the Brazilian flag colors here. So if you haven't noticed that, that's a little touch on design. But I love Brazilian assets. I do think that, there is a lot of room for folks to find opportunities in these types of markets. Let's go to the next chart. It's South America overall. I'm almost done. But interesting. This chart is interesting. It's kind of a good how bubbles are formed, right? We go from a takeoff phase, and then we have that first sell-off, the bear trap. You think it's done. It's not. It's the beginning. And then it goes crazy, gets media attention, enthusiasm, greed, delusion, new paradigm. And then it starts the denial phase, return to normal. And then, I just wanted to see what a chart that looks exactly like this. Let's go to the next chart. Here it is, the venture capital index. I mean, this is a Reuters, Thomson Reuters venture capital index, and it looks just like this. It's just we've been to the new paradigm. We declined. We've got into a denial, and now we're back to the return to normal era. And I think this is also a function of interest rates and cost of capital too. As cost of capital rises, makes it the idea of doing venture capital extremely difficult. And so, in my view, this is a classic kind of chart of how bubbles are formed. And I think this has been one of the most successful ways of investing in the last decade or so, has been venture capital and private equity. And I would suspect that these things are not at the beginning, are probably at the very end of their cycle itself. And so that return to normal to me seems very appropriate as in terms of where we are as a roadmap to this overall space. Let's go to the next chart. I'm almost done, promise. Very last, think about the risk reward when you invest on anything. This is, you look back in election years and prior, this has been one of the best years ever in history of election years. And so, what's your risk reward if you're coming in today? Not very favorable, especially when you think about where CAPE ratio is or any valuation metric at one of the highest levels in history. Is this my last chart? I believe so. Let's go to the next one. One more. Okay, auto loans versus risk-free rate. This is just looking at the white line is the auto loans rate, and the red line is looking at the 5-year rate because it's a 6-month actually rate as well. And you can see that there's a divergence between the two. The green line is just showing the difference between the two. So what does that mean? That means that if you're a lender of auto, for car loans and so forth, what you're doing is you're seeing the risk from the consumer side, and you're not willing to lower your rates, even with the interest rates itself actually declining. And so that is usually a sign of fragility in the markets and in the credit markets overall. And this is a good one. This is a very interesting type of divergence that you tend to see prior to recessions. I don't need to say, which I will say, that during the global financial crisis, that divergence was also the case, and we're seeing again today. So, something to be aware of as well. I think this is my last chart. Let's prove that. There you go, Quentin. On you, man.
On for the geologist. Okay. I think the best slide I could find on the internet to kind of portray a lot of what, I got to reduce everything to pictures, okay, because these guys are talking way up here. I was like, okay, I get it. But this kind of sums it up, leading a horse to water and trying to make the sucker drink. Okay, so if you think about the past couple of years, it has been a protracted period where it looks like, the thesis should play out, but it hasn't. Kevin touched on that in his discussion. But we're there now, and I think Tavi made several points that really are compelling. That we are definitely at the pond, and it's time to start drinking some water. And if anything, once these funds and retail investors and so forth kind of wake up and realize that the commodity world has something to offer, especially mining stocks, things could turn around really quickly. And we've been preaching this for a while now. We're that cowboy down there taking his first gulp of water in many days. Horse is a little reluctant, thinking the guy's a little crazy. Hey, you know what? That horse is going to be down there drinking pretty soon. By the way, there are a few investors. There's a few. See the back there in the back? There's a few investors who they're the guys guys and gals that watch this video, right? They're out there drinking from the pond. They've been doing so, and they've been getting good deals. They can drink and they can buy cheap stock for the past couple of years. Now they're all set. They're all full. Their tummies are full. They can go hang out under that tree, catch some shade, and get some shut-eye. The rest of them,
Eric Wetterling on the back there.
I think you're right. I think that's it. All right. Well, we like to have fun too. All right, let's go to the next slide. So, kind of rejiggered our presentation format here. I am sticking to the boring geology lecture. That is my job. Okay, is to make sure everybody gets their weekly dose of boring geology. And this week, I'm going to pick up where I left off last week. Okay, we're going to talk about what sounds like esoteric geology about gold, but it's actually very important. I'm going to show you why. There's a slide in here that explains why everything I'm trying to teach you guys is very important to the gold mining industry. And it's all about how we treat gold ores, how we recover gold out of rock. Okay, go to the next slide. Okay, so last week I talked about where gold is. I said, there's a little bit in rocks around us. The Earth's crust as a whole, about 2 parts per billion. There's a little bit of gold, very, very little bit in ocean water. But we got to upgrade. We got to take that gold from that very dispersed form and bring it together and put it into a much smaller volume of rock to create ore. Okay, ore is basically economic rock. It's rock that contains enough gold that can be recovered to be of economic significance, effectively. All right, let's go to the next slide. I'm not going to, if you want to watch more about these slides, you can go back to next week's video. I'm just simply recapping. Okay, so I talked about how gold is concentrated in the environment. There's really physical methods, i.e. gravity, creates placer deposits, things like that. Then there's chemical methods where gold is actually, in the case of in the red circle, they're carried in solutions, carried in hot waters, hydrothermal, so water, hydro, and then thermal being hot. Hot waters can carry a bit of gold. They can actually dissolve gold and carry it. They can first of all, they can scavenge all that gold from a large volume of rock, bring it together, and then move it and then redeposit it in concentrated form elsewhere. Okay, so hydrothermal gold is basically the predominant way gold is formed on Earth in this day and age. Let's go to the next slide. Okay, and then I talked about the process that occurs here. So we have to take our source rocks, which are about 2 parts per billion, and we gotta pull that gold together, usually with hot waters that contain salt, sodium chloride. Up in the blue there, you can see H2S, that's hydrogen sulfide. CO2, which is carbon dioxide. If you start putting those ingredients in the water, they can do a good job of carrying gold. And most gold is carried as what we call a bisulfide complex, which I show with the red arrow there. Au and then HS 2-. That's HS is hydrogen sulfide. It's in ionic form, so it's 2-. But basically, the gold is bound to sulfur and hydrogen in that case. Okay, now gold, a little bit, I didn't mention this last week, but a little bit of gold can also be carried as what we call a chloride complex. Okay, gold can combine with chlorine atoms and form ions that way that can go into solution as well. Not quite as soluble as gold bisulfide, but it's also an ore carrying compound. All right. Now, that solution, that gold-bearing solution, is now what we call an ore-forming solution. It's more concentrated. Usually, ore-forming solutions, they've scavenged all that gold out of that low-grade rock, and they've brought it together. The gold-bearing solutions tend to run maybe a few tens of ppb, parts per billion, up to maybe a few thousand in very rare cases. Okay, sometimes it can be very concentrated. But those ore-forming fluids, once they've done their job and they've gathered up all that gold, they then can move through the Earth's crust and they can find a new home. Usually they move upward through the crust. And then as they get close to surface, as they get close to the surface, which is much cooler, it's got oxygen in the atmosphere and so forth, they go through processes listed in green there where the change in the fluid can actually result in the deposition of the gold. Okay, you can do cooling. You can cool the fluid down, the temperature. These fluids often are at several hundred degrees Celsius. They can be that hot because they're under pressure, but they can be very hot and carry that dissolved gold. But when they get to surface, they can cool right down even below boiling. Okay, and that helps deposit gold. You can introduce oxygen into the fluids. Oxygen basically breaks off that sulfur from the gold, and gold can't be carried in solution anymore. You can mix fluids. You can take like shallow groundwaters and mix it with hot fluids coming up, and in doing so, deposit gold. Boiling is a good way to deposit gold. Fluid segregation, when you get fluids separating like water and carbon dioxide, that's a good mechanism for depositing gold. And flashing is basically when a fluid becomes over pressurized and it just decides to blow through the surface. That can cause gold deposition. Very rapid change in chemistry. Go to the next slide. Okay, and that's what we touched on last week. There was that eruption in Yellowstone. That was a gold forming event. It was a hydrothermal eruption. That flashing event basically caused gold to precipitate. A lot of that dark stuff you see in that cloud that erupted is actually minerals coming out, and that includes gold, okay, which is crazy to think about, but there you have it in real life. Let's go to the next slide. And it forms wonderful deposits like this. These are samples of extremely high-grade gold that form rapidly in hydrothermal eruptions. This comes from a deposit in Nevada called the Sleeper Mine. I found these photos off the internet. Sleeper's no longer an active mine, but boy, when it was first found, it was one of the most incredible gold discoveries in human history. Extremely high-grade. You can see the beautiful nature of these samples. But these are rare. Okay, these are not common. They're fairly rare to find gold deposits where you have just a lot of visible gold in them like this, and not much else. I mean, there's silica, that's the matrix of the rock, that dark brown stuff, but you don't have much else, like pyrite and stuff like that. Okay, so this is a pretty rare occurrence. Go to the next slide. Obviously, it's rare, or we'd have more gold, and we know what to do with it. I also mentioned about fluid separation, where things like water and CO2 can separate, and in doing so, it changes the chemistry of the fluid, and it causes the gold to precipitate as the sulfur, the hydrogen sulfide, breaks down and leaves it. Okay, this is a case where you form things like epizonal gold deposits. You can form over a pretty narrow, say a few hundred meters vertical profile. You can form extremely high-grade gold in a system where the fluids are under pressure and then they rapidly rise up through the surface, usually during an earthquake or seismic event or something along a fault. Those fluids rush up, the gases separate, or the fluids separate, and the gold just literally dumps right out. And what do we get from that? Go to the next slide. We get things like this. This is out of the Fosterville mine in Victoria, Australia. Beautiful, beautiful gold, native gold. Again, it looks a lot like the Sleeper samples. It effectively is the same thing. Like a geologist talking, epizonal, orogenic, and hot spring, and all these fancy terms. Really, it's about the process. Okay, it's about the processes that form the gold. That's critical. And if you think in terms of processes, the process that formed this gold in this orogenic system is really not all that different in many ways than, say, the hot spring at Sleeper. Okay, but you end up with the same product here, a beautiful visible gold in quartz. All right, so those are rare. Those are very, very rare. Okay, these are not something you find every day. What's an example out there? Well, Fosterville is about mined out, at least the high grade. What's the best example right now? Newfound gold. Okay, Newfound gold is exactly one of these types of systems. And now we're gonna dive into something else. Go to the next slide. We are now going to shift gears, and we're going to talk about what happens when gold precipitates with other minerals and metals and stuff. And in particular, we're going to talk about, in a broad category class, we'll call it pyritic gold ores or sulfide ores. Sulfide ores is another way to think about it. So it's gold that's precipitating along with sulfide minerals, predominantly pyrite, but maybe other things too. All right, let's go to the next slide. Okay, here's a view of the periodic table of the elements. And what I've done here is I've circled things that like to travel with gold. Okay, some of these elements are metals that we desire as people. We need them, like copper and zinc and silver. And I've put big thick red circles around those because frequently we see gold travel with those metals. Okay, it's not uncommon to find gold occurring with copper or any of these metals. Sometimes you also see a bit of nickel and cobalt. Okay, I put a little bit thinner line there because they're not quite as abundant, but they kind of tag along now and again. Then over here in the pink, what I've done there is I've circled a bunch of elements that travel along with gold, but they're not necessarily of economic importance. What we call these guys are pathfinder elements. Why? Because they travel with gold, and if we analyze for these elements like arsenic and antimony and stuff, if we analyze for those elements when we're doing sampling out in the field, like rock chip sampling or soil sampling or stuff like this, they can actually be kind of an indicator, a proxy for potential gold mineralization. Okay, so they're very, very useful tools in that regard. Not necessarily economically important, but they sure are for exploration. Okay, and then in the green up there, what I've circled, sulfur and chlorine. Why? Because those are the two elements that gold likes to travel with. Okay, so those are basically the elements that gold can glom onto in solution and travel in hot waters. Okay, now over here on the far left in yellow, I've circled iron, Fe. Okay, why have I circled iron? Because this is a biggie. Okay. A lot of gold deposits also have a lot of iron with them. The iron precipitates in various forms, often as pyrite, what we saw in the previous photograph. Okay, and pyrite, as you know, looks kind of like gold. It's kind of yellowish and shiny. A lot of people look at it, that looks like gold. And nope, it's not gold. It's fool's gold, what we call fool's gold. So oftentimes fool's gold and gold occur together. Okay. But we're going to talk about, this iron because it is so common. It is so common to see iron in the form of pyrite and other minerals with gold. All right, let's go to the next slide. Okay, so we're going to go through kind of a spectrum of sulfide ores, pyrite ores that range from, we'll call it metallurgically wonderful to metallurgically problematic. Okay, we're going to go through a spectrum of different rocks. These are rocks of that have gold in them, but they have pyrite and other things, and sometimes they're great. You can treat them. In other words, they're no problem. Other times, they're very difficult. Okay. All right, so these images actually come out of Goliath. Okay, these are from a news release a few weeks ago. They simply show some pieces of core. I've labeled the gold and AU in bright yellow there. But these pieces of core have different minerals. First of all, the white stuff is mainly quartz, not entirely, but probably mainly quartz. Okay, but the rocks have pyrite. I've labeled that in orange. They have galena and sphalerite. Galena is a lead sulfide, and sphalerite is zinc sulfide. Galena is kind of a bluish, sparkly mineral. Sphalerite is kind of a dark, kind of lacks luster. It's not very sparkly. It's kind of a dark, almost resinous mineral, often black or brown or something like that. Okay, so these are minerals that we see frequently together in Goliath ore. But notice the gold is often very coarse. It's like coarse particles, little nuggets and stuff. That's interesting. Why is it interesting? Because coarse gold is good for recovery. You can get that gold out through gravity recovery, and you can produce doré, which is basically raw smelted gold on site from that gravity gold. That is wonderful. Okay, and Goliath has a lot of gravity gold they can get out. With the test work they've done, shows about a half of the gold in the rock, maybe even more, comes out through gravity separation. That's the cheapest, easiest way to get the gold out. So here we have a sulfide ore that has coarse gold in it and is a wonderful material to recover the gold from. Okay, so all sulfide ores are not bad. Okay, this is a case of a very, very good one. Now, the finer grain particles of gold that are probably scattered through that rock can also be recovered. And the way you do that is you grind up the rock and you actually float the sulfide minerals. You put it in flotation cells. I've talked about this in previous videos, where you introduce detergents and the bubbles glom onto the little sulfide particles and they float up to the top. And you catch that froth that comes off the tank because it's got all your goodies in it. It's got lead and zinc and gold and silver and everything in it. All right, and you can actually produce what's called a flotation concentrate that's going to contain very high contents of those metals, right? And that material, again, here at Goliath, they've proved through metallurgical testing that they can get a great flotation concentrate. And it's wonderful to see because you can now build a mill that gets most of your gold through gravity. The rest of it comes out through a flotation concentrate. You don't need to use cyanide or leaching or anything else complicated. Okay, it's very simple. And that flotation concentrate, you can ship that anywhere on the planet and they will gobble it up right now. The smelters absolutely love that stuff. They're paying premiums for gold and silver concentrates. The gold and silver markets are really heating up, and those smelters, they want that material, okay, because they can get added value for it when they smelt. Okay, and by the way, Goliath happens to be very close to tidewater. Okay, so it looks like it's way up in the mountains, but in fact, it's within a couple of kilometers of the ocean. Okay, where you can put it on a boat and ship the darn stuff. All right, let's go to the next slide. Okay, now some pyritic gold ores have a lot, like proportionally, they have a lot more pyrite in them. In fact, maybe there's not much of any quartz. These two images are basically, they're what we call photomicrographs. They're pieces of rock that have been sliced and then polished really well so that we can see the minerals. And the yellowish stuff, the kind of brassy looking stuff, that's pyrite. Okay, there's a little bit of galena in that one on the left. But the bright yellow stuff, the stuff that looks almost like butter through there, that is gold. Okay, AU, that's gold. And you can see in this case, the gold is pretty tightly bound in the pyrite. Some of it's actually in little holes and pockets tucked through the pyrite. Other kind of wanders through it like almost like a fluid or something. All right, and then over here on the right hand side, you can see there's a gold grain entirely encapsulated within the pyrite grain. And for scale, that 100 microns, I mean, that 100 microns is 1/10 of a millimeter. So that piece of pyrite on the right hand side is probably about like a couple of hair widths or something wide. It's very, very thin. So you can imagine, I mean, a little gold particle like that tied up in pyrite, it starts to be more interesting because you have to do something to get it out, right? You got to grind it finer. Okay, so when you see pyritic ores like this, it means you have to grind the rock finer so that it can bust everything up to get that particle of gold out of there. All right, so finer grinding is needed when you see pyritic ores like this. It's not quite as easy as what I showed you in the previous slide, but it's still recoverable. Okay, you can grind it a little bit finer, which means you need to put more energy into your mill when it's spinning around and banging the rock up. But if you can get it fine enough, that gold will separate. Okay, now some of that gold you might be able to get recover through gravity recovery. Okay, just like the previous slide. But if you can grind it fine enough, in this case, you can leach it with cyanide. CN is cyanide. Okay, so cyanide leaching in this case, like, in a tank, a vat, think, you can leach the gold out and you can get great recovery. So this rock, even though you have to put more energy into it to get the gold out, you still get good gold recovery. Okay, it's not so bad, not so bad. It's pyrite ores, not so bad recovery. All right, let's go to the next slide. Okay, now we're going to go into the world of problematic gold. Okay, what the heck are we looking at here? Okay, so down here in the lower left-hand side is a piece of Carlin gold ore. This is sedimentary rock. You can see the layers are kind of folded up and stuff, but it's sedimentary rock that has little specks of pyrite. They're so tiny you couldn't even see them. Like if you held the rock, it just looked gray to me. Like you can't see it. You get your hand on that, maybe you can start to see little tiny spots of pyrite. They're so doggone small, they're pretty bloody hard to see. All right, but they're in there, and that's where the gold is. Okay, and you can start to imagine, wow, that gold is really, really, really fine grade. It must be to be in that rock because there's nothing very big to see in that rock, like big mineral crystals and stuff. Okay, so what are we looking at with the bright colors in the back there? Well, they've done a lot of studies of these rocks, these sedimentary hosted gold deposits, what we call refractory gold deposits. And they'll take a rock and they'll slab it, and then again they'll polish it really well. They have to polish it super well because the mineral grains are super fine here. But then they put it in a machine that actually bombards the minerals with energy, like an electron beam or something like this. And because the polished pyrite grain in this case, which is what you see in the upper left, gets bombarded with that energy, the elements that are, the atoms in that grain are excited, and they in turn, we'll call it, reflect back in a sense, they reflect back energy of different wavelengths. All right, so it can actually help you see where elements are in that pyrite grain. Okay, and if you cast your eye across each image here, it's the same pyrite grain in each one. And what we're seeing are simply maps of where the elements are distributed within that pyrite grain. Very interesting. Okay, so like the one immediately to the right of the pyrite grain, that bright red thing, that's sulfur. Well, sulfur, what's pyrite made out of? Iron sulfide. Okay, that's telling you where the bloody sulfur is in that rock or in that pyrite grain. The next one, iron. Yep, they've had to kind of ratchet down the color scale there, but you can see where the iron is distributed, and obviously it's kind of distributed through the whole thing. Okay, but let's just jump to the chase here. Down on the second row, over on the left, you can see arsenic. Arsenic is often, like I said, travels with gold. It's often there. And this pyrite happens to have a ton of arsenic in it. It's what we call arsenian pyrite. Arsenian pyrite. And the arsenic is actually distributed through the pyrite at atomic level, literally atom by atom. Occasionally, one of the sulfur atoms is replaced by an arsenic atom. Okay, and that's why when they do the heat map, the map of where the metal is, you can see arsenic is quite abundant in certain layers, and you can even see the layers now. You can see that it's banded. Okay, it's like got zones within. So as it grew, there was a period there right at the end where it was growing lots of arsenic. Okay, well, guess what? The next image over with the purple arrow, that shows you where the gold is. Again, the gold in this case is atomic. Okay, it's atoms of gold that are inside the pyrite itself. The gold atoms are replacing, probably iron or something in the pyrite lattice, the crystal itself. You don't see gold particles here, okay? In these systems, there are no visible particles. The gold is actually locked up in the crystal itself. That's crazy, isn't it? Yes, that is crazy, because that means that things like a solution, you can't leach it, okay? Because you can't readily dissolve, say, a pyrite grain with cyanide. You can dissolve the gold if the gold was available, but it's tied up in the mineral. All right, so it's what we call refractory. It's difficult to recover. Okay, now look, this is very important. These types of deposits they're very abundant on Earth in terms of, there's a lot of inventory out there of refractory deposits. Because why? Because they're difficult to process. Okay, so if you look at the inventories of projects out there that we currently have in the gold space, there's a disproportionate number of refractory deposits that have not yet been developed because they need extra capital. They're capital intensive to get that gold out. It's going to take energy and more advanced equipment and stuff, and they're more expensive. Okay, but it's really important for retail investors in particular to understand this, because if you're investing in the gold story, you got to know if the rock is refractory or not, because that is going to play into the quality of that deposit. Now, when I was at Newmont, they literally just beat, metallurgy into your head every day. Okay, we would actually start our exploration program by studying metallurgy of the area that we were going to look, okay, let's see what the gold looks like. Let's see if the gold is in a form that's readily extractable. If it's not, why are you going to explore there? Because you're just going to find something that's going to be a head bang. Okay. Okay. So it's really important to invest in that with that same philosophy that okay, I like the two slides that I showed you earlier, but this one's a problem. This is a problem. All right, go to the next slide. Okay, now there's also very rare, very, very rare, but there are also times when gold itself will combine with other elements in the periodic table and create gold-bearing minerals. In this case, these are what we call tellurides. That's calaverite, which is a gold telluride. On the left-hand side, it kind of looks like banded. It looks like sticks of celery or something. It's really finely striated, but it's a beautiful mineral. It's absolutely gorgeous. Okay, and when gold is bound up with tellurium as a telluride, you can't leach it. Okay, it will not dissolve in solutions. All right, now how do you get the bugger stuff out of there? Well, you can float the telluride. You can actually grind up the rock and float the tellurides and produce a very rich gold tellurium concentrate. No problem. That's one way. The other way, you roast the darn stuff. You actually put it in an oven or a furnace and you roast it. You raise the temperature to a level that's high enough that the tellurium itself, which is a fairly volatile metal, okay, burns off. It just, burns away. It boils away kind of like, water would boil away. And what does it do? It leaves behind little droplets of gold. So over here on the right-hand side, that's a roasted piece of gold or a gold telluride ore where the tellurium has been burned off, and you get these little buttons of gold left, okay? These are not particularly common ores on Earth, but they're occasionally out there, and you got to be aware of them, all right? Let's go to the next slide. Now, why is all this important? Well, I've talked in the past about how you process gold ores. This is kind of a refresh, okay? There's different ways. You got gravity recovery. Gravity is when you grind up the rock and you actually use different means. You use like a Nelson concentrator, which uses centripetal force, or a shaker table, a Whiffley table or something like this, to actually get the gold particles to separate out. But that's the cheapest, easiest gold recovery you can experience. And I talked about it in regards to Goliath. I mean, that beautiful gravity recoverable gold is wonderful. It means cheap processing. Carbon and leach, what is this? Well, this is when you grind up the rock and the gold is able to dissolve in cyanide solution, sodium cyanide solution. And then you put carbon particles in there too. Okay, so you basically stir up that ground up rock with a cyanide solution and little bits of carbon, and the gold dissolves out of the mud, the slurry, and it gets reprecipitated on the carbon. Then you scoop off the carbon and you pull the gold off the carbon, and you can melt it down and produce doré. So carbon, CIL, that's a chemical means of extracting gold. You can often do a combination. You can have gravity and CIL. That's very common to see in a mill. You can have both of them utilized. Flotation, what is that? That's when you take the rock, you grind it up, and you mix it with detergents and stuff that kick up a lot of bubbles, and all of the sulfides in the rock float up to surface. And you can do it in stages. You can float, pyrite and then zinc and lead and stuff, or you can just float everything up at once. There's different ways to do it, but you can produce a concentrate. Basically, in a mill, you can concentrate your minerals, including gold, through flotation. That's another way. Okay, pressure leach. What is this? Look, this is when you basically put your gold concentrate, usually from flotation or something like that, into a little vessel where you're actually putting your solutions under pressure. Okay, like it's a little, think of it like a little submarine or something. It's a very compact piece of equipment that keeps your solutions under extremely high pressure and basically forces them to bond to that gold and strip the gold out. So you can leach gold under pressure. That's another method. You can do what's called pressure oxidation and autoclave. Look, at autoclave is effectively a pressure leach system as well. But pressure oxidation is when you got gold locked up in sulfides. Okay, when you have refractory ore, you have to oxidize the sulfide, the pyrite. And the way you do that is under pressure. You put it in a vessel. In this case, an autoclave is a pretty big vessel. It's usually about the size of a submarine, probably 50 meters long and probably 20 meters around or something like this. It's a big ding-dang vessel that holds a lot of ground up rock, gold ore. The gold ore goes in, and then you pull in a bunch of oxygen out of the atmosphere. You pipe it in there too under pressure, and you heat it up. And what happens is the oxygen corrodes away all of that pyrite. It basically strips the sulfur out. It oxidizes the pyrite, which frees up the gold. Okay, so pressure oxidation autoclave is a way to treat refractory ores. Okay, now I mentioned roasting. Roasting, you can do things like telluride ores. Like I said earlier, you can heat the rock up, burn stuff off, and free up the gold. Same happens with some sulfide ores too. There's a lot of ores in Nevada where back in the early days they said, bugger it, this gold's tied up in this very fine pyrite. Let's just roast the stuff. They just said, let's roast it. Let's put it in a big. And there were places like at Getchell where they had these roasters, and they would just, put all the rock through, and the smoke would come out the stack, and there was arsenic and stuff going every which way. It was a nightmare. All right, but so you don't see roasters so much anymore, but it used to be a pretty common way to oxidize rock so that you could free up gold. Okay, and it's still used today. We put what are called scrubbers. They pull the gases coming out of the roaster, and they basically clean the gases out and put them into a form that's not dangerous to the environment. Okay, all right, but roasting is still used. Biooxidation, at least, look, there's very few plants left in the world that do biooxidation. There's a few. I've been to a couple. It's really interesting. They basically you grind up the gold ore and you put it through tanks, and the tanks have cultures of bacteria in them that love to munch up pyrite. Okay, so these things get eaten up. I realize how late it is. We're running late today, guys, aren't we? Bugger me. Oh, jeez. Okay, the pyrite gets eaten up by bugs, and as it does, you can leach the gold out of the residue. Okay, so that you can leach it with cyanide, and you can get the gold out. So biooxidation is another technique. I've talked about heap leach, where you stack the rock. Okay, and it's got to be free milling gold. Like, it can't be tied up in pyrite. If it's refractory, it doesn't work. Okay, but if it's not refractory, you can stack it up, sprinkle solutions through it, and then collect those solutions, extract the gold that way. Lastly, amalgamation. Sometimes there are still plants on Earth that use mercury to scavenge gold. Okay, you grind up the rock, and then it's almost like a gravity separation, but you get the particles to go over a plate of mercury, and the mercury picks out the gold. It likes to stick to the gold. Okay, so amalgamation, not too widely used anymore because of the dangers of mercury, but it is still out there. Okay, now I realize I got to get my skates on here, guys. So we got a few updates. Let's go to the next slide. Let's go. One more. Okay, Sitka. I'm going to give the 3-minute version because I want people to listen to this. It's evolved into what I think is one of the most exciting gold stories in modern time. Okay, I mean, this includes Snowline. Okay, I think they're onto something big here. I'm saying that with all sincerity. Okay, this week they announced some of their first results from the summer drilling. They got 290 meters of 1.1 gram, and it includes a bit higher grade interval of 105 meters, 1.68 gram. Okay, now they've also mentioned that some of the holes are drilling right now, the C and VG. Now, they've already talked about this like a few weeks ago, but they continue to see visible gold and sheeted veining in these holes. So we've got a lot of holes coming that are going to come over the next few weeks out of the lab and are going to produce really, really strong results like this. Let's go to the next slide. Now, I got to give a bit of a refresh. We're talking reduced intrusive gold deposits. This is the schematic model for reduced gold deposits. Okay, if you think about this, this is an intrusion, like a big magma chamber at depth, and these apophyses of magma separate, and they have a disproportionate amount of gold. The gold is actually carried probably in the magma, but as the magma cools and stuff, the gold gets pushed out into the fluids that form, and it creates a variety of gold deposits, sheeted veins. Sometimes it's disseminated, sometimes it's in breccias and stuff. They see all of these at Sitka. And what it tells me is that at Sitka, they're within the mothership. I mean, they are truly, they are in the Goldilocks zone within one of these systems because they have virtually the entire thing preserved. Okay, so this is important for exploration, to know where you're at in the ore system. I think at Sitka, they are, go to the next slide, very high up in one of these systems. Why do I say that? Okay, let's look at the geology of the property. Look at all these red polygons with the little hatcher in the background there. Those are individual granite bodies sticking up out of the ground, okay? And they've drilled some of these. They've drilled some of these granite bodies, and they've also picked up that Victoria ground. Thank God they picked up that Victoria ground when they did, because if they had been a day later, they wouldn't have got it. Think about it. Okay, but they picked it up on the day of the collapse, and it was crazy. But they have enough data from here to start to make a picture evoke in one's head. And I just so happened to work really hard today to put together an accurate geologic depiction of what's going on here. So go to the next slide. Okay, you are right there, okay? You're right about the tippy top of that one little pajinga stick. We're going X-rated here, guys. Sorry. All right. The way to think of these granite bodies is what I've presented here. I will credit a friend of mine, Mike Russell, who actually used this for the first time in his dissertation on a project in Nevada. But anyway, the way to think of these systems is very large magma chamber, at depth, and then you have these pajingas sticking out, these udders, okay? And at this point, Sitka has really just tested the very, very tippy top of several of these pajingases, all right? Well, what happens when you go deeper or they come together? Or we have the whole pajinga, like the whole bazanga is there, okay? I'm not kidding you. Like, this is why it is so freaking important that people understand the context of these drill holes, because they have the whole enchilada. They have the whole ding dang cow down there.
This is literally a cash cow.
This is a cash cow. I'm not kidding you, man. Let's go to the next slide. Okay, so we're going to talk about the one that they drilled this week. I mean, we are dealing with like little individual drills, and it's like I want to talk about the big picture, right? So I'll show you the 3D model here in a second. Okay, so we're right here at the blackjack target. This is one of the pajingas sticking up, all right? They have lots of holes. You can look at the colors down here. They've got lots of holes they've completed and have yet to come back. We know there's visible gold in some of them. we're going to see some really nice assays. And they're drilling some more holes in there. There's that green one that's in progress, and it's going a bit deeper. And I'll show you why here in just a jiffy. Okay, go to the next slide. Okay, this is a simple cross-sectional view through the headline hole. This is hole 62, and you can see it hit 290 meters, 1.1 gram. There are 2 higher grade intervals in there. Wonderful. Okay, if these holes were all hitting 0.6 gram or 0.8 gram or something, I wouldn't even bother talking to you guys right now. Okay, that's not what. But when I see the high grade, that's what I'm looking for. When I see a reduced intrusive system that has capability of generating, gram plus type grades, doesn't have to be all holes, but at least quite a few of them. Those are the ones you want. That's the one you focus on. Okay, and that's what we have here. So we have a wonderful high grade intercept. Go to the next slide. People say, "Oh, it's deep. It's deep. It's deep." Damn, it's really deep. Everybody emails me and says, "You know what? You can bulk mine this underground all day long." Okay, this is like 0.8 or 0.9 gram or percent copper equivalent. Okay, and there's a zillion copper mines around the planet that are mining underground at those kind of grades. So there's no problem. Okay, here's the other cross section. This is a bit lower. It is a 0.6 gram interval, but still a pretty good interval. Let's go to the next slide. Here's our core. You can see the sheeted veins. This is out of hole 62. It's out of the higher grade area. Notice the texture. See the intrusive with all those little white dots scattered through. Oh my gosh, that is texturally, that is the tippy top. You're right in the udder. Okay, like I see that and I get all tingly. Now I'm gonna share the 3D model here, and hopefully this puppy doesn't give me fits and kittens here. Let's do share. There we go. Is it showing up now?
Yes.
Okay, seabed markets are close because, man, this is such a beautiful story. Anyway, okay, this is a 3D model. Okay, we're gonna look at this for a second. I want people to kick back and enjoy this puppy. All right. Okay, I'm gonna gradually turn. This is the map they provide with the news release. So my guy just simply took the map and he clipped it out and draped it over the topography here. Okay, I'm going to turn this down a wee bit, and you'll see where they've drilled right away. See the colors? Those are the udders. Those are the udders poking their way up. All right, so the rest of the cows down below there, but we're going to take a look at what we're seeing so far. Okay. That's all they drilled. Think about the rest of the cow. The rest of the cows down here. Hello. What is not to understand here? This is crazy. Okay, so we're going to go up here to where they drilled or announced the holes this week. This area here is blackjack, by the way. Okay, so I'm going to, let's see, I'm going to recenter the image right there. Hold on, I got to go underneath there. Sorry, a little obnoxious. There. Now it's centered on that drilling. Guys, the scale is crazy. Okay, this is 1,000. Like as I zoom in and out, okay, you'll see the scale bar change. It's down here in the lower right. But just to give you a sense of scale, that's enormous already. That's like, 500 meters vertically or something, and like 700 meters this way or like this is already taken shape to be very, very big. Wow. Okay, and then let's look at our holes. This guy right here, that's our headline hole. Okay, that's on the south side of a fence, and I'll tell you, I love core, but I'll tell you what, I want to see them have a little more aggressive step outs here. Okay, that's like what 45 meters or some friggin' thing, whatever. I want to see go over here, go over here, book a hole. All right, because I think this thing is just warming up. Look at all the high grade down there. If you just cast your eye, the purple is the high grade. And this puppy is just warming up down here. In fact, that hole that they released ends in mineralization. It ends in high grade. That's why that green hole that they're drilling right now, I think, is going to go deeper, and it's going to test down in this part of the world. Okay, but I think we're going to see there's going to be a big old body of gold right about there, and it's going to be pretty ding-dang good. If we scoop back and then start thinking about the other udders here. Look, this is the other one. I can't even think of the name of the darn thing. Okay, can't remember, Eiger deposit. Okay, they barely pricked the surface here. They have little pops and whistles. They're kind of low grade, but it doesn't bother me because the higher grade is probably going to be down here. The rest of the caliber, remember, is down here. Okay, this is a company maker deposit in my view. In my view, this is a discovery that is going to grow and grow and grow. You got to have. We're going to have intestinal fortitude to watch them drill some deep holes and stuff. But there is a bunch of gold here, a bunch. Now, my guy spent this week farting around with the historic data from down here in the ground they picked up from Victoria. So this area, and this area includes historic drilling that he's managed to pull together through reading a bunch of historic 43-101 and stuff, and actually put into the computer. These are drill holes, guys. I mean, they barely prick the surface here, but they've already got, like, there's a string of 1 gram there, there's a string of 1 gram there. All of these holes end in mineralization, by the way. I mean, that's crazy. Okay, this stuff back here, almost all of these holes end in mineralization. Some very high grade. Look at there's 2 grams right there, 1.66, 1.154. Hello. Blah. Okay, there's a bunch of gold here. There's even this little doodad here. I don't know the name of all of these bugger things, but whatever. Look at the grades in this puppy. Okay, look at the grades in here. 10 grams, 4.8 grams. I can't even see this one. Let's click on it and find out. What is it? 1.62 grams, 3.41 grams. This is crazy. Okay, this thing has barely been drilled, and virtually all those holes end in mineralization. If people don't get it, I don't know what to do with them. Right? I gotta stop sharing there. Okay, sorry, get too excited. Go to back to the deck. Okay. Oh, my battery's running low. Hold on.
Hope we don't lose him. Did we lose him? Oh no.
Whoop.
Guys, give it a second. He's back.
Am I still? I am. This fucking battery just it came loose from the wall behind me. I think skidded my chair. Okay, sorry. I'm back.
Your
on.
camera is off now, by the way. For those who don't believe this is live, you're seeing it live right now.
I'll turn my camera on. Okay. blah blah. Whatever. Yeah. Okay. I hope I'm back in the saddle here. But my the plug thing back in the wall here. I'm not at my house or office. Go to the next slide. Let's get cracking here, guys. Okay, this is these are photomicrographs out of core of visible gold particles from Sitka, from the drill holes that they're drilling right now. These are holes that haven't been assayed yet, but they're coming up. Okay, you remember what I just lectured everybody on metallurgy? Look at this gold. Do you see it tied up in pyrite? Nope. Does that mean a good thing? Yep. Is it coarse enough to get through gravity? Yep. This is dream type stuff. Okay, this is absolutely wonderful mineralization, gold that's going to be easily recoverable. All right, so pay attention. Let's go to the next slide. Okay, Alamera. The guys had Dick Silito come to site about May, I think, or June or sometime, and Dick basically said, "You guys are on the porphyries. Okay, you need to start thinking about porphyries." And so they've really taken off their blinders, and they've gone out and they started a prospect around the Cajuero and even their other Apiacus and the other projects, okay, Elena and so forth. And they've really started to think about these systems as porphyry systems. And lo and behold, they found a new porphyry east of Maria Bonita. This is an area in the Cajuero property. I will remind everybody that Cajuero already has a resource of like 600,000 or 700,000 ounces. Maria Bonita, which has just been recently drilled, probably adds to that. Don't know how much, but it should add a fair bit. Okay, but now they have a new porphyry, and I think this is quite exciting. Go to the next slide. Okay, so we can see Maria Bonita is in red there. It's that little tiny red blob. This is magnetics. But now they have this, okay, Tavi, I need the Portuguese help. Mombaque. How would you say it? Mombeke?
Wait, say it again. What do you? Oh, Mombaki.
Mombaki. Okay, Mombaki. Thank you. Good thing we have the Portuguese help today. Okay, Mombaki. Look, this looks like it could be the mothership. And it so happens that there are artisanal alluvial miners who are cluing into this area and actually mining the surface material coming off of this thing recently. So that's interesting. Okay, go to the next slide. And then the rocks they're finding, look, no assays yet, but they got so excited by what they're finding here that they wanted to throw some of this stuff into a news release. The stuff on the left, that's the porphyry. You can see the big crystals in there, the big feldspar crystals, classic porphyry. Looks very, very interesting. But in places over here on the right, it's got intense quartz veining, stockwork quartz veining, almost like sheeted veining. Think very much like what I just showed you from Sitka or something like that. Okay, we don't have assays from this stuff yet. Don't know if it has gold. Have no clue, but it looks pretty interesting. And these guys are out there aggressively pursuing new targets. And I think this is wonderful. Okay, go to the next slide. Novo announced some results from Belltopper. I'm co-chairman of Novo. Belltopper is in Victoria in Australia. It's an orogenic deposit, and we went back and we found a bunch of historic core and actually assayed it and found significant gold mineralization in areas that had never been assayed before. Why, I don't know. But this was an important exercise because it's starting to present a bit more enticing picture here. Go to the next slide. You can see in cross-sectional view, and my team, I'll tell you, does the most detailed cross-sections. I give them an A+ every time I see their cross-section. Okay, but you can see the drill holes there in blue. Those are some of those historic drill holes, and lo and behold, they're finding all sorts of lodes way up the tippy tops of all those drill holes. What does it mean? It probably means there's a more of a root or core structure or structures that are projecting down to depth. Okay, so there's a lot more, in other words, there's a lot of runway below where this historic drilling was undertaken. Okay, so this is giving us room to start thinking a little bit more about the structures and what might be going on there. Isn't a home run yet? No, but it looks interesting. Looks very interesting. Okay, go to the next slide. I know we're running way late. This is a record lateness today. Barksdale. I told everybody I like to get my hands on companies and kind of, like really compelling stories like Barksdale. Wow, it's right next to Taylor deposit, right? $2 billion mine going in. $2 billion. Okay. Hello. We got the rest of the ore body. Okay, let's go find that sucker. Let's go find it. So we got a geologist, Alan Roberts. He's driving. I talked to him yesterday. He's driving down to Arizona. He's getting his butt down there. And he's getting ready to drill. Okay, I think probably mid-September we should be in a position we can drill. Okay, I'm working with the company on other things too because there's stuff that just needs to get done. But we're going to get ships don't turn around on a dime. Okay, it takes a few weeks or a month. But I've joined as director. We're going to get this thing going again. We're going to get her fired up. Let's go. Next one. Okay, Nevada King. I got to touch on this because this is quite interesting. This is a bona fide step-out drill hole well west of the Atlanta deposit and resource. They hit 42.7 meters, nearly 5 grams per ton. It's a 199 gram meter hole. Let's go to the next slide. You can see in the plan view where this is. The pit is over there in the black with the hatchet, little dash lines. And then, we're, I don't know how many meters, I can't read the bloody scale, but anyway, we're a few hundred meters off to the west of the pit in an area that really hadn't been drilled before. So this is a bona fide step out. It looks like the system is trending, to the northwest. They've got other holes in there that have now hit mineralization, but it really is going to open this thing up. You go to the next slide. Now it is deep. Okay, that is the one, comment I got to make. It's deep, and you can see how ding dang deep it is here. Okay, so that green corridor is where they've been drilling recently. And you can see they've hit these exceptional intervals of oxide mineralization, 42 meters of 5 grams down there at depth. Now, is it too deep? No, I don't think so, because if you think about this in the third dimension, they can start mining and then incrementally strip as they pull into this area. In other words, they don't have to like lift all that rock up at once. You can do it in increments. So my gut says, even though it's deep, I think this should work as a mine, especially given it's oxide. Oxide means the sulfur is not there. Your gold is free to recover. It means cheaper recovery. It's not refractory. You don't have to spend a fortune on recovery. You can focus on just putting your costs elsewhere, like mining. Okay, so I believe that's it. Go to the next slide. Okay, I guess we're done.
All right. Thank you, Quentin. Whoop. I'll back to that one. All right. You can lead a horse to water, but you can't make him drink. So we're trying to lead some people to some water. We're trying to get them to drink. And it's, we think we've got a pretty exciting portfolio of exploration companies that are onto some really exciting discoveries and incipient discoveries. They don't. All the drill stories don't work. There is risk in this industry and in the segment of the industry. So that's something to point out too. Because like Quentin was showing you, those super high grade, wonderful gold deposits that flash instantly. They're extremely rare, and there's all different kinds of deposits. Drilling costs a lot of money, and but is it worth it? Absolutely, we think it's worth it. The risk reward from a portfolio approach to investing in exploration is you only need 20% of the portfolio to have good success to make up for the other 80% that may not. And that's just how it works. And so, that's why, every drill program does not yield a success, but enough of them do to make this very worthwhile, a good risk reward, we believe, as a strategy for, not just for getting exposure to commodities and to precious metals and other, and copper too, but to, and zinc as well, but to get to, outperforming the metal price at the end of the day, because that's the big opportunity here. That's why we're doing this. Tavi and I are interested in gold and silver and copper and zinc for macro reasons. But we want to outperform the metal itself. That's why we're working with Quentin. That's why we're going for high alpha too. And we, it's risky, but the reward is worth that risk. So let's, Tavi, any final comments?
No, this was great. Thanks, everybody, for the presentations. This was a good week. Lots of things that I think happen according to our views as well. And if you have any interest in Crescat, I would suggest you to speak with Merrick. The email address is on the screen. There's also a phone number. You can give him a call and ask him more about the strategies and what we do. In regards to the miners, the precious metals fund, where we are mostly invested in exploration stocks, and those names are not part of the GDXJ, with the exception of maybe one or two. But those are the opportunities that we view as the large asymmetry in the next few years here for Crescat and for our investors as well. So if you are interested in learning more about that, I suggest you to speak with Merrick. If you want to follow us in terms of more of these videos, I suggest you also to follow the Crescat YouTube channel. And we'll be back next week with more. But thanks everybody for watching, and let's see each other next week. Take care.
Thanks.